Hello everyone. What a start to the month. Indian equity market not only witnessed and embraced the volatility of the Union Budget 2026-27, but also was surprised with the announcement of the India and US much anticipated trade deal. In August 2025, when Donald Trump levied 25% punitive tariff on India on account of the import of the Russian oil, it has created a lot of pressure on the Indian equities performance since then. Since August 2025 till Jan end 2026, FI sold almost 1,40,000 crore of Indian equities, which explains the underperformance of Nifty 50 compared to the other emerging markets in the time period. Nifty 50 gave a return of mere 2% compared to almost 15 to 20% performance of various emerging markets in that time period. However, if we see deeper, we see the bloodbath witnessed in the broader market. During the same time period, small cap index was down almost 10%. Whereas if we go deeper, micro cap was down further at almost 13%. What was more destabilizing is the kind of performance of Indian currency proved during the time period. INR was trading at almost 88 to a dollar in August, and it depreciated by almost 4.5% to 92 by Jan 2026 end. This not only created a risk of sentiment, but put India out of favor among global investors. Now, with this much, I would say the toughest overhang on the Indian market is behind us. With this deal signing, we believe the Indian risk premium on equity has gone down. We expect a couple of things to play out in the coming quarters. First, we expect the Indian INR to appreciate from here onwards, not only on account of the strong macroeconomic fundamentals, a sensible and a credible budget, but also on account of slowing out of money going out of India in the coming quarters. Second, we also expect that FI will start appreciating the kind of earning trajectory that we have witnessed so far. In this quarter, though we have seen almost 40% of the company reported their results, the BSE 500 PAT growth of almost 15% is more or less in line with expectations. But what is really encouraging is that if you see the large cap portion of the result that have come so far, gave almost 12% kind of PAT growth year on year, and mid cap is almost at 16%. But the small cap, which has been lagging so far, came out with almost 34% growth year on year. Now, the underperformance of the broader market over the last 1.5 years, we believe this is a catalyst time where we will start seeing this reversal of the underperformance. This will happen on account of the kind of risk on sentiment building up gradually, better earning trajectory, strong macroeconomic indicators, and all the initiative taken by government and RBI to play out in the coming times. Even on valuations, now we believe that market is in sync with the long-term averages, and at least the froth is out of the system. Globally, though, there is a lot of volatility, but if we witness the kind of carnage in the commodities, as well as the AI and the technology stock out of favor, we believe India will find its favor among the global investors as a hedge against that. So to summarize, it's just not only the kind of earning trajectory which will provide the much needed support, but strong macroeconomic indicators and the positive geopolitical situation of India with US provided the much needed support for the Indian market. So overall, we believe that the Indian equities will perform much better compared to the other global markets in the incoming year. Thank you.